This is Barry Norman on behalf of Alvexo, and welcome to our webinar on technical analysis. Now, tonight's class is sponsored by Alvexo, one of the world's leading Forex and CFD providers. Now, Alvexo is regulated in many markets around the world, and they only offer trading in countries and zones that they are regulated. So if you can't access their site, means that they're not regulated in your home country. But if you like, tonight you can go to www.alvexo.com and open a demo account while we're in class and follow along using their charts and their technical indicators. And then you'll have your demo account. There's no credit card or deposit required. Just simply take a username and password and move on forward and get a demo account and try out trading on the Alvexo platform. Because their web trader is one of the most advanced and dynamic platforms available. It's easy to use, nothing to download. Just simply use a username and password and log in. You get one-click trading, real-time quotes, high-speed execution, and all order entry types. If you want more advanced trading, you can download the Alvexo MetaTrader 4 platform to give you the feeling and the requirements needed by professional traders who want to automate some of their trading, who want to add on expert advisors, and want to have the most advanced charts downloaded on their computer. Either way you wish to trade is perfectly fine. I prefer online trading than downloading, but it's up to you individually. They offer both. There's no charge for them, and you can actually use both. It's up to you. They also generate free signals twice a day. They have an 85% accuracy, an 88% accuracy, and they're free. They're pushed out to you right on the platform or through whatever method you've denoted, and you get these immediately and can use them to help make your trading decisions. Now, tonight's class is being recorded, and you can access a recorded version of this class in about 24 hours by going to investing.com, where you register for the class, and just click on webinars and then webinars on demand. And you'll be able to watch a recorded version of this webinar tomorrow. Now, because Alvexo is a regulated provider, I must read you a risk warning. So let me get that out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. So let's get moving forward with getting a handle on technical analysis. Now, traders who subscribe to technical analysis operate under the fundamental theory that price moves in patterns and that price never lies. Now, to an inexperienced eye, a financial chart may look like an unpredictable line with a jumble of colors and marks on it. But these traders are watching charts to pick up on the subtlest of indicators of where share prices or asset prices could be headed next. Now, I explain it like a roadmap. Now, when I started driving and I started, working, I had a business partner in London, and we would have to drive all over to appointments outside of London, all over the UK. Now, my business partner was an excellent navigator because he could read a road map and tell you what every one of those lines and every one of those little dots and dashes and colors meant. Me, if I was going to the appointment alone, I'd call and say, how do I get to you? And they'd say, take the M5, go to this exit, get off at this exit, turn right, turn left, turn right again, and then look for our signing, pull in our parking lot. Well, me, I'd inevitably get lost. I'd be filling in filling stations, asking directions. So I always had to leave an extra half hour to get to my meeting to make sure I was on time. So when I was driving with Peter, my business partner, he'd open up that atlas, pull out the roadmap of wherever we're going, and he would say to me, in 2 minutes, pull over to your right, we'll be passing a filling station, then you'll see the school, then you'll see the church. As soon as we pass the church, turn to your right. And I'm saying, how does he know all this? He's reading all of these symbols on a chart. And by understanding your charts, you could get where you're going more successfully. And anything involved using a chart falls in the area of technical analysis. Now, In this world of technical analysis, there are many different modes. We have chart patterns like triangles and head and shoulders patterns and wedges and flags. And these are the part of technical analysis that involves these repeated formations of these patterns on a price chart. Then we also have things like candlesticks and reading Japanese candlesticks and reading the position of the candlestick and understanding the battle of the bulls and the bears. And then lastly, we have the whole area of what's called technical indicators. And technical indicators are mathematical calculations that can be applied to an asset's past patterns like price or volume and even other technical indicators. These technical indicators do not analyze any part of the fundamental business like earnings or revenue or profit margin. They don't look at news or headlines. They look at only price action. And the result is a value that is used to alert traders about a trend, to predict the direction of future prices, and confirm the technical analysis suggested by other indicators. And these include categories, and these are, again, all put on charts, but they're put below the price. A very few are actually dropped on the price, but we have things like moving averages and Bollinger Bands that are actually placed over top of the charts. Then you have Fibonacci levels, which are placed on the right of a chart. But all these involve price movement on charts. But this whole category of technical indicators is a big field of technical analysis. And these technical indicators come in categories, and we know them all. We know lots of names of them. You know, I get new traders, and the first thing they say, I want to trade RSI, or I'm using stochastics, or I'm using MACD. But they don't even understand where they fit into the scheme of things. So let's talk about technical indicators, because we can't cover the whole field of technical analysis in one night. So we're going to deal with technical indicators. And technical indicators fall mainly into two categories: leading and lagging indicators. Well, the minute you say lagging, people say, I don't want something that's lagging. I don't want something that's past due. You know, that lagging means behind. Yeah, there's nothing wrong with a lagging indicator. The difference is leading indicators, those who lead price movement. They give us a signal before a new trend or a reversal occurs. So since nothing can tell you that you're actually at the very top of the trend at that moment, all it can do is lead you and tell you that the market is overbought or oversold, or that the market is ready to reverse. Not at what point it's going to reverse, it's getting to that point. That's called a leading indicator. A lagging indicator are those who follow price action. They give a signal after the trend or the reversal has started. So a lagging indicator actually tells you that uptrend it was in is over and is now moved into a downtrend. Indicators from both categories belong to one of the following types. We have trend indicators, we have momentum indicators, volatility indicators, or volume indicators. And this is a big problem for most beginning traders, because they don't understand the categories. So they have a buddy who tells them, well, you know, RSI and stochastics are great. So they say, okay, I'll learn about both of them, and I'm going to use both of them. Well, the fact is, both of them are the same indicators that give you the same results. Well, why wouldn't you trade indicators from different categories that give you more information about the market? So the first and one of the most important categories are what we call identifying trends or trend indicators. So identifying trends over different time frames is useful because it can help weed out all the noise of daily volatility, and any type of trend, including uptrends, downtrends, and sideways trends, can be traded for profit as long as it's shown itself to be consistent. Trend traders use a number of different indicators to help them figure out what kind of trend an asset is in. One of the most popular of these indicators is moving averages, which is represented by a single line that represents an asset's price over a given period. Okay. Other examples of trend indicators include moving average convergence and divergence, average directional index, SARs, and linear regression. So let me pop up a chart, and we're going to take a look at what the simple moving average is, that's a trend indicator that you can put on your chart. So hold on a second. There we go. It's going to pop up on your screen in a second. And so we're looking at right now just a chart of the euro US dollar. Now I've already got them set up, so I'm just going to pop on them so you can see them. And I'm just dropping on the chart two moving averages. You can see them in the squiggly lines going through the candlesticks. One's a purple line, and I've just set them up to be purple and gold. And one is a gold line. Okay, this is called moving average crossovers. Now, what a moving average does, it takes the noise out of the markets. Okay? A moving average, simply, what's a moving average? Is an average. Okay, if you're using a 10 period or 20 period, and you have to decide what period moving average you want to use. And there's all types of strategies. But if you're using a 10 period moving average and you're looking at, like we are, the euro US dollar for 1 hour chart, means every one of these candles put on it at each hour. And you would take the close of each hour, add the last 10 hours together, divide them by 10, and that would give you the current moving average for a 10 period moving average. You put that dot on the chart and then you connect all the dots together, and it simply smooths out all the noise that you see in the market between the highs and the lows and the poppings and the movement, and gives you a better understanding of how that trend is moving. By combining that indicator with a second moving average of a longer term, you're now having a moving average crossover. So in other words, in this case, we're using a 10 period and a 20 period. Well, the 10 to 20 period is what we call the slower moving average because it's less responsive to the markets, using 20 periods and dividing by 20 as opposed to 10 periods. So 10 periods is more reactionary because it's going to use the most current prices. And whenever we have those crossover, it's either giving us a buy or a sell signal. This is an indicator. Now it's giving us a signal. It's not telling you to do something. It's giving you indications that can be used in your trading strategy. And this is called a trend indicator. It's an important indicator, and it's a big important part of technical analysis. Okay. We also have other ones that are called, like another popular trend indicator is called MACD. And MACD is put on the bottom of your chart, and it gives you a MACD line and a signal line that are calculated using the moving averages. And when those MACD and its trigger line cross over each other, it generates transaction signals, buy and sell signals, but using a slightly different method. Okay, and if you notice, they're in slightly different positions. So here we have the crossover right here. Here with our other moving average, we had the actual crossover here. Which is right, which is wrong, I don't know. But here we had another crossover right here, right at that point. So we could use these in conjunction with each other to make sure that both of them are giving us the same information at the same point. But they are both trend indicators. Another field is, hold on, let me get back to my PowerPoint. The next type of indicator we want to talk about is volume indicators. Volume, if you're going to use a trend indicator, there's no sense in using more than one. Okay. Now, you can use one to support the other if you wish, if you understand why you're using the two. But volume indicators are also very important because volume tells you how much the traders believe in that movement. Or when you see that crossover of that buy signal, are the traders pushing the volume up? Does that mean that they see this and they're all jumping in the market also? Or are they saying, no, that's not a good signal, and so you see a low volume? So the volume can help support whether you are, whether the other supporters believe in this. So sometimes market conditions and the lack of liquidity alone can temporarily drive an asset price higher or lower. However, these moves are often occur on relatively low volume and can be short-lived. On the other hand, if an asset moves in a big move on extremely high volume, that's a reliable signal that there's major buying and selling going on. The third type of indicator, and volume is placed on your charts, and there's different types of indicators, but you can also just place straight volume on your charts, and volume is denoted on the on the bottom of your chart. And we'll get over and take a look at volume in a minute. And then there's a third type of indicator called momentum indicators. Now, momentum indicators are very important because they're like speedometers for traders. They show how fast an asset is moving in a given direction. These indicators are typically displayed as what we call oscillators, which fluctuate above and below a baseline. For instance, RSI and stochastics, no matter what mathematical calculation you use, come in between 0 and 100. And they're plotted on a chart between 0 and 100. And there's a range over 30 or under 70 that are considered overbought and oversold. That's telling you the markets have moved up too high in price too quickly or fallen down in price too low. Then we have other things like stochastics, we have CCI, we have Chande's momentum indicator, Williams percent R. But the most popular ones are RSI and stochastics. RSI is a great indicator, and it will tell you if markets are overbought and what the speed of the movement is. And then we have volatility indicators. Volatility is a measure of how large an asset's movement is in a given period of time. When an asset makes large moves in a short period of time, it's considered to be very volatile. Volatility is a very important indicator for traders because volatility makes it easy to profit due to price inefficiencies. Without volatility, trading opportunities would be limited. So we have Bollinger Bands, we have trading envelopes, we have the VIX. Okay, we have all different types of metrics to figure out how volatile the market is. So let's go over and look at a live chart again. There we go. So right now, I'm going to drop on here Bollinger Bands, because Bollinger Bands is a true volatility indicator. And we can see how volatile the market is by the width of the bands. This channel in between you see in green over top, the wider that is, the more volatile the market is. The narrower it is, the more contracted the market is. Now, you have to learn how to use Bollinger Bands, but you'd expect when price is moving up that it rides along the upper band, and when price is falling, it rides below the lower band. But it also tells you how volatile the market is. So if you wanted to enter a market and you need to put a stop loss and take profit, you would have to look at that type total movement, because that's how that asset is moving at that time. So that's a volatility indicator. We can also add on here RSI. Okay, and like I said, RSI is considered an oscillator because however it's calculated, it always comes in between 0 and 100. The purple area here is what we can call dead man zone. It's between the area of 30 and 70. It tells us nothing. So we're looking at it to be in the 0 to 30 range or the 70 to 100 range. And then it's telling you the market is either overbought, like here, and here we see the price has surged all the way up. Buyers had jumped in the market. Now it's overbought and the price reversed itself and started moving down. We can see here as price get oversold, that means the price is too many sellers in the marketplace, and then the buyers will start entering. All of these fall in the area of different types of technical indicators. So let's break down the categories again. Let me go back to my PowerPoint. Okay. So the first group we have are trend indicators. And these include moving averages, moving average convergence, invergence known as MACD, or parabolic stops and reverses. Okay. Parabolic stops and reversals are leading, where moving averages and MACD are lagging indicators. Remember, leading indicators give signals that when a trend is about to start, and lagging are those that are following the price action. These technical indicators measure the direction and the strength of a trend by comparing price to an established baseline. These indicators are designed to show traders and investors the trend or the direction of an asset they are trading. The trend is an asset can be either downward or upward. Trend followers are an example of traders who use trade indicators. Now I'm going to run you a video on trends so that you understand them a little bit better. It was done by a friend of mine, And we're going to run it right on your screen so you can watch it right in class. And then we're going to come back and talk about momentum and volatility again. So let me pop. Okay, so we saw how these trends move. Now, if you follow the support and resistance trend lines, and basically when you look at the chart that's in front of you, that's what I have. If you look at the purple lines, I mean the gold lines, the purple lines, the dotted red lines, the solid red are all support and resistance lines that I've drawn on the chart for previous classes. Now, if you were to follow this along, okay, and when it broke a support line, like say it did just today, a resistance line, right here, you might sell that asset. But how would you know that it should be a sell? How would you know it's just not happening? How would you know that it's actually a good transaction signal? Well, if you use it with other indicators, look at what happened to our RSI at that moment. RSI moved into the overbought move, so it's telling us it's too many buyers in the marketplace. It's telling us the prices are going to fall. We didn't get a crossover in our MACD. We had a crossover much earlier. In fact, they're diverging. So MACD is not giving us a signal at all here. It gave us an earlier signal to sell at this point when it moved into sideways congestion. Maybe it just didn't happen until this point, but we're down here. But we also have our Fibonacci levels on here, and price broke below the Fibonacci level. Then we could do one last thing, one last decision maker, and that is to add volume. Okay, volume is very important because if the traders felt the same way you feel, you would see an increase in selling. You'd have more activity in the marketplace. Volume would be increasing. So I just want to open this up more, so I'm going to get rid of some of these indicators on our charts. Okay, so now we have volume on the very bottom of the chart. And look at what happened when that candlestick broke that resistance level, volume surged. That's telling you the traders are entering the marketplace. They believe in this new downtrend. So when it broke here, they entered as sell. So now you have several different technical indicators supporting the idea of selling. And you got this from technical indicators and analysis. We haven't looked at the asset, the price, why the euro is going up and down. We haven't looked at any fundamental analysis. Now, we've combined several different pieces of information, but we've used pieces of information that fit different categories of indicators. Because if you're using the same category of indicators, you're just duplicating your results, and you're not getting any really good results. So here, we're supporting this move by several different types of technical analysis. So understanding and learning where these indicators fall and how they work and what should be combined together will help you have a powerful trading strategy. Uh-oh, give me 1 second to get my marker off here. So remember, we have momentum indicators. So in this case, we use relative strength index, RSI, which is a leading indicator. But we could have used stochastics or CCI. Okay, so these indicators that fall under momentum, these are technical indicators may identify the speed of a price movement by comparing the current closing price with the previous. Stochastics oscillators are used to predict price turning points by comparing the closing price to its range. Relative strength index measures recent trading strength, velocity of change in the trend, and magnitude of the move. The momentum is a measure of speed at which the value of a security is moving in a given period. Momentum indicators focus on stocks and assets that are moving significantly in one direction on high volume. Then we also included volatility, and we did that with Bollinger Bands. Okay, these are all lagging indicators. These technical indicators measure the rate of price movement regardless of the direction. Bollinger Bands measure the highness and the lowness of price relative to the previous trades by developing the band. Volatility is so important in trading that you can find several indicators that measure it to generate signals. The volatility is the relative rate at which the price of a security is moving up or down. A high volatility occurs when the price moves up or down quickly. So these include Bollinger Bands, envelopes, and projection oscillators. Okay, and then lastly, we have volume indicators, which I use real volume. You can use a Chaikin oscillator, you can use an on-balance volume indicator, or volume rate of change. These technical indicators measure the strength of a trend based on the volume of contracts or shares being traded. The volume of trades is a very important component to trading. It is, for example, used to confirm or infirm a continuation or a change in an asset's direction. And then we have overbought and oversold. Okay, now these are two words that are complicated to most people to use. We talked about RSI and stochastics, above 30 and below 70. When an asset is overbought, the implication is that buying has pushed the price too far up and a reaction called a price pullback is expected. When an asset is oversold, the implication is that selling has pushed the price down too far and a reaction called a price bounce is expected. Okay, indicators serve three broad functions: to alert, confirm, and to predict. An indicator can act as an alert to study price action a little more closely. If momentum is waning, it may be a signal to watch for a break of support. Or if there is a relatively positive divergence building, it may serve as an alert to watch for a resistance breakout. Indicators can be used to confirm other technical analysis tools. If there's a breakout on the price chart, a corresponding moving average crossover could serve to confirm a breakout. Some investors and traders use indicators to predict the direction of future prices. Now remember, indicators indicate. They are just one field of technical analysis. This may sound straightforward, but sometimes traders ignore the price action of an asset and focus solely on an indicator. Indicators filter price action with formulas. As such, they are derivatives and not direct reflections of price action. This should be taken into consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. Never ever take your focus off of how price is moving. What the indicator is saying about price action of a security is the price action getting stronger or weaker. Even though it may be obvious when indicators generate buy and sell signals, the signals should be taken in context with other technical analysis tools. Any indicator may flash a buy signal, but is the chart pattern showing a descending triangle with a series of declining peaks. It may be a false signal. That's why we use things like support and resistance and Fibonacci levels. They help see whether the signal is actually a good signal. As always in technical analysis, learning how to read indicators is more than an art than a science. The same indicator may exhibit different behavioral patterns when applied to different assets. There are hundreds of indicators in use today, with new indicators being created every week. Technical analysis software programs come with dozens of indicators built in and even allow users to create their own. Given the amount of hype that is associated with indicators, choosing an indicator to follow can be a daunting task. Even with the introduction of hundreds of new indicators, only a select few offer a different perspective and are worthy of our attention. Strangely enough, the indicators that usually merit the most attention are those that have been around the longest of time and have stood the test of time. That's why you hear everybody talking about RSI, stochastics, MACD, Bollinger Band. They have been around for 20, 30, 40 years, and they've withstood this test of time. There's always new stuff coming in the market. Okay, there's always new people, new gurus preaching new stuff. So when choosing an indicator to use for analysis, choose carefully and moderately. Attempts to cover more than 5 indicators are usually futile. It is best to focus on 2 or 3 indicators and learn their intricacies inside and out. Try to choose indicators that complement each other instead of those that move in unison and generate the same signal. For example, it would be redundant to use 2 indicators that are good for showing overbought and oversold levels, such as stochastics and RSI. But I don't know why, but a billion traders do. Both of these indicators measure momentum, and both have overbought and oversold levels. Remember the difference between leading and lagging. Okay. That's always very important. And because they each have their own benefits and drawbacks. Okay. Understand what they are and make sure that you know whether you're using a leading or a lagging. As their name implies, lagging indicators follow price action and commonly referred to as trend following indicators. Now, for technical indicators, there is a trade-off between sensitivity and consistency. In the ideal world, we want an indicator that is sensitive price movement, gives early signals, and has few false signals. That's like asking for 3 wishes from the genie. If we increase the sensitivity by reducing the number of periods, an indicator will provide early signals, but the number of false signals will increase. So where the longer a moving average is, the slower it will react and the fewer signals is generated. So when you decide what type of moving averages, what periods you want to use, be aware of how you set, or use the standard 30, 60, 90, depending on the time frame you want to trade and how you want to trade. Okay. Understand the different types of oscillators. Okay. But stay with the primary ones. MACD is a great one because it gives you overbought, oversold. It gives you convergence and divergence. So it will serve 3 purposes by using 1 indicator. Stochastics and RSI are the world's leading overbought and oversold indicators. So there are a lot of choices out there. And finally, oscillators are the most effective when used in conjunction with pattern analysis, support and resistance identification, trend identification, and other technical analysis tools. Like I showed you in that video, setting up support and resistance is very easy. And then using that in conjunction with other tools might give you a trading system. Support, resistance, a volume indicator, a momentum indicator, and guess what? You got yourself a trading system. By using other technical and other analysis techniques in conjunction with oscillator readings, the chances of success can be greatly enhanced. And on that note, I'm going to say thank you very much. Go to www.alvexo.com and set up a demo account and follow along, use their education, use their classes. They have all types of videos you can watch and all types of ebooks on technical analysis and in-depth studies of each of the different indicators that will help you figure out what type of indicators you'd like to add to your trading system. Have a good night. Thank you very much. And remember, you can see a recorded version of tonight's class tomorrow by using the same link or going over to investing.com and clicking on webinars on demand. Thank you very much and have a good evening now.